Hi, everybody. Welcome or welcome back. My name is Mandy. I'm a financial coach. And on this channel, I talk about money, banking, debt, getting out of debt quickly using a concept called velocity banking, and building generational wealth. And today I'm going to talk about the concept of velocity banking in general terms. I wanted to answer a few questions about velocity banking in general. The first being, what is velocity banking, right? Velocity banking is really just a different, more efficient way of using tools we already have. It's not a new product, and it's not a new item. It's just a different way of looking at things to help us get out of debt more quickly. And what it does is, the second question, how does it work? It makes use of the concept of simple interest and revolving credit. So just a basic example, and the numbers I'm about to use, I do have the full example of this person's numbers in another video, which I'll link below. But I just want to point out how it works. It uses simple interest, and it reduces the amount of interest that you pay so that you're able to pay off your debt faster. So this person I've been working with, he has $5,800 in credit card balance, and his minimum payment is $215 a month. And again, I'm doing this from memory, so the numbers may not be exactly what they are in the other video, so please forgive me for that. But he roughly pays $154 a month in interest on that balance. And this is without him making any additional charges. He's just making the minimum payment every month. So if you subtract these two, you get $61 a month that is actually going towards paying down that $5,800. You can, if you divide $5,800 by $61, you can see it's going to take a very long time to pay off. And in fact, that number is about 49 months, right? And each month, yes, the interest does go down by a little bit, but because the balance is only going down by about $61, the interest only drops by $1.50 to $2 every month. With velocity banking, on the other hand, and again, these numbers are from memory, the velocity banking concept, the interest in the first month is already down to approximately $136. Month 2, I think it's somewhere around $124. Month 3, I believe it's down somewhere around $107, and so on. So you can see that the first month in doing velocity banking, he's already paying about $20, $22 less in interest than he's paying per month, just following the way we're all taught to do minimum payments. So the next question that I get asked a lot is, will velocity banking work for me? Is it right for me? The answer is maybe. The method does work. It's essentially just math. There's no magic to it. There's no special voodoo behind it, but there's a couple situations where it may not be the best choice for you. The first being if you have problems sticking to a budget, if you have problems with shopping and spending, it's not for you. This method can and will get you out of debt very quickly, but if you're not able to stick to a budget, it will not work for you. So if you're able to get that under control, by all means, once you get it under control, go ahead and see what velocity banking can do for you. The second situation where it may not be right for you in your situation, or may not be right for you yet, is if you have a large negative cash flow. So if your cash flow is $500, $600, $700, $800, $1,000 in the negative every month, it won't work for you. It's not to say it'll never work for you, but you have some legwork to do first. You'll need to get into positive cash flow through either bringing in more income, reducing expenses, or some combination thereof. So if you're in the third group and you're saying, well, I have positive cash flow and I'm good with my money, how does it work? What do I need to do to get started? So what you need to get started at a very basic level, you need to know your numbers. And I'm putting a lot of exclamation points because that is the number one most important thing that you need to have to get started with Velocity Banking. As a colleague of mine says, what gets measured gets improved, right? I know, and I know from experience, especially if you have a large amount of debt, it can be easier to just not think about it. If I can't see it, it can't hurt me, right? But you can't plan a road trip if you don't know your starting point. All right, so you need to know your numbers, and there are 4 basic numbers that you need to know in order to start calculating and figure out if it will work for you. So you need to know your net income, which is your income after taxes, so the amount of money that you have deposited into your checking account every month, or the check you cash at the bank. You need to know your expenses, and this is your living expenses. And that's every dollar that leaves your house during the month. So whether that's groceries, gas for your car, utilities, Netflix subscription, gym membership, every expense, including giving, tithing, all of that is included in your expenses. You need to know your debt payments. And debt payments are just what they sound like. It's the amount of money that you have to pay towards any debts that you have every month. So mortgage payment, car payment, student loan payment, minimum credit card payments. Those are your debt payment totals. And then you need a line of credit. Oops, sorry about that. You need a line of credit. And I know I forgot number 4 above, and I'm going back to that. You need to know your cash flow. Your cash flow is your net income minus your living expenses and your debt payments. And I do have another video specifically on how to calculate your cash flow, and I will link that down below. And then the second thing that you need is a line of credit, an LOC, or the ability to get one. So there are HELOCs, which is a home equity line of credit, PLOC or personal line of credit, a BLOC or business line of credit, and then credit cards. You can also do Velocity Banking with credit cards. Now, the rate at which you can pay off your debt with Velocity Banking depends on several of these factors combined, and it also depends on the type of line of credit you're using. And I won't get into that in detail here, but you can look through my other videos and find scenarios using different types of lines of credit, and you'll be able to see what I mean. And then the third thing that you need, a lot of people think this is funny when I say this, but you need an open mind. And the reason I say you need an open mind is because it is a shift in how you think. Most of us were traditionally taught, money works this way. You get paid, you put it into a bank account, you pay your bills, you might save a little, poof, the money's gone. And that's how it goes over and over again every month. This concept teaches using revolving credit to pay off debt, including amortized debt. So yes, we're talking about using a line of credit to pay off a mortgage, for example. I won't get into that here, but that can be really hard to wrap your head around, especially if you were like me, raised to get your check, pay your bills, you're done. So you do need an open mind, not only to grasp the concept, but also to accept that it does work. Because at the end of the day, it is just math, right? There's not magic. Nobody's selling you an additional product. It's not a new item. It's just math, but you're putting your money to work for you instead of to work for the bank. So I hope this helped to kind of give a basic overview of what Velocity Banking is. It is a lot easier to understand the inner workings of it looking at examples. So please check out some of my other videos. Again, I have examples of many different situations, scenarios using different types of lines of credit, different amounts of cash flow, and so on. So if this was helpful, hit that like button and subscribe. And if you have any questions or comments, leave them below. I will respond, and I will see you in another video.